Smart Money Concepts (SMC), Understanding Institutional Trading Mechanics. Smart Money Concepts or SMC represents a highly advanced trading methodology that focuses on how institutional traders such as hedge funds, banks, market makers, and algorithms manipulate and move the market. Retail traders focus on indicators, candlestick patterns, support or resistance lines. But institutions control 70 to 90% of the trading volume, which means the market moves according to institutional logic, not retail logic. To succeed long term, traders must understand why price moves, not just how it looks on a chart. This chapter explores SMC in deep detail covering market manipulation, liquidity engineering, displacement, market structure, supply and demand, order blocks, fair value gaps, institutional order flow. The core idea behind smart money concepts. SMC is based on simple truth. Big players need liquidity to enter and exit positions, but their orders are so large that they cannot execute them at once. They cannot reveal their intentions. They need to disguise their entries. They need retail traders to provide liquidity. Thus, institutions manipulate the market to trigger stop losses, trap retail traders, create artificial moves, engineer liquidity zones, create false breakouts, cause rapid reversals. SMC helps traders understand this hidden logic. The three pillar of smart money concept. SMC is built on three fundamental pillars. Liquidity. Institutional traders target area where retail orders are clustered. Example: buy stops above highs, sell stops below lows, support or resistance trap, psychological round numbers, equal highs or lows. Liquidity provides the fuel for big moves. Market structure. Institutions move the market through POS, break of structure, change of character, displacement, pullbacks into premium or discounted zone. Structure reveals their intentions. Imbalances. Fast price movement leaves inefficiencies. Fair value gaps, breaker blocks, volume imbalance, price inefficiencies. These imbalances serve as targets and entry zones. Liquidity, the heartbeat of institutional trading. Liquidity is where orders rest. It is the foundation of SMC theory. Types of liquidity: buy side liquidity, stop losses, buy stops and breakout traders above previous highs, equal highs, resistance levels. Institutions push price up to collect this liquidity before reversing. Sell side liquidity, stop losses and sell stops below swing lows, equal lows, support zones. Price is pushed down to sweep stops, then aggressively moves upward. Internal liquidity, liquidity inside consolidation ranges, triangle, flags, etc. Institutions manipulate these zones for accumulation or distribution. Institutional market structure, the real structure behind price. Institutions create structure intentionally. Bullish sequence, institutional trend, sweep sell side liquidity, change of character upward, displacement, FVG creation, pull back into discount zones, continue making HH or HL. Bearish sequence, sweep buy side liquidity, change of character downward, displacement, pull back into premium zones, continuing making LL or LH. Professional traders identify where institutions may enter and exit. Order blocks, the origin of institutional moves. An order block is the candle or zone where institutions place large orders causing major reversal, BOS, strong displacements. Types of order blocks. Bullish order blocks last bearish candle before a strong upward move. Bearish order candle last bullish candle before a strong downward move. Why order block works? They represent institutional accumulation or distribution. Price often return to these levels to mitigate or fill unfilled orders. They act as high probability entry zones. Order blocks are the geographical home of institutional buy or sell orders. Fair value gap, the imbalance theory. A fair value gap forms when a strong displacement moves occurs, leaving no counter order between three candles, creating an inefficiency in price. Example: candle 1, Candle 2 large move. Candle 3. If candle 3 doesn't overlap candle 1's wick, then fair value gap. Why fair value gaps matter? Price eventually returns to rebalance. Institutions use fair value gaps as entry zones. Fair value gaps confirm strong institutional activity. In SMC, and fair value gap is one of the strongest confluences of four entries. Displacement, the signature of smart money. Displacement equals to strong impulsive move that break multiple structures. Characteristics: long candles, high volume, fast movement. POS accompanied by fair value gap. Displacement confirms institutional presence, direction bias, trend strength. Where displacement starts, institutions often entered. Where displacement ends, institutions often target liquidity. Premium and discount zones, the fair price theory. Price is only worth buying in discount and worth selling in premium. How to determine zones? Use Fibonacci: 50%, 61.8%, 70.5%. Map swing high to swing low. Discount zone below 50%. Institutions buy here. Premium zone above 50%. Institutions sell here. This is the secret behind institutional accumulation and distribution. The SMC trading model, institutional entry blueprint, a full SMC model involves determined buys, HTF trend, major liquidity target, fair value gap, and displacement zones. Liquidity sweep. Wait for price to grab equal highs or lows, support or resistance stop, internal range liquidity. Change of character or BOS confirmation. A structural break validates shift to power. Return to zone of interest. Price returns to order block. FVG, breaker block, mitigation block, discount or premium area. Refined entry, LTF confirmation, micro BOS, engulfing candle, FVG rejection, liquidity tab. Stop loss placement, below structure or OB wick. Targets, next liquidity pools, highs, lows, imbalances, inefficiencies. This model gives extremely high RRR trades 1:5 to 1:20. Why retail traders lose against smart money? Retail traders rely on indicators, breakout patterns, trend lines, obvious support or resistance. Institutions use these to trap retail. Retail traders buy breakout, institutions sell into them. Hold losing positions emotionally. Use tight SL that get hunted. Misunderstand trend reversal. Chase entries. SMC gives traders the ability to avoid traps, anticipate manipulation, understand true market direction. Breaking the illusion. Markets are engineered. Markets are not random, they follow liquidity engineering, algorithmic models, institutional order flow, volatility patterns, accumulation or distribution cycles. Price doesn't move to your support or resistance line, it moves to collect liquidity, then deliver institutional order flow. Understanding this transforms your entry trading approach. Final thoughts. Mastering smart money concept. Smart money concept provide a deeper, more realistic understanding of how markets operate. By mastering SMC, you learn to think like institutions, avoid retail traps, trade with the trend's real direction, use liquidity as your compass, build high RRR setups, understand price movement logically. SMC is not magic, it is advanced market logic. It reveals not just what price is doing, but why it is doing it.